Live from Singapore, this is Insight with me, Haslinda Amin, where we dive deeper into stories that matter with crucial context and sharp analysis. A Hong Kong court sentences former democracy activist Benny Tai to 10 years in prison under a China-imposed security law. The move could further deter dissent in the city and attract fresh condemnation from Western governments. The sentencing coming with top leaders from the global finance industry in Hong Kong as the city pushes to revive its image as a financial hub. We are live at the HKMA event. Also ahead, markets across the world closely watching Donald Trump's cabinet picks with his threat of a tougher stance on China and higher tariffs putting global growth at risk. We have a stellar lineup of guests to discuss the risks and opportunities. abrdn's Chairman Douglas Flint is up first on the market's outlook. For a deeper dive on U.S.-China relations, we speak to Amy Celico, and former economic officer to Beijing. And of course, we get you a view from one of Asia's top consumer businesses. Bill Heinecke is the founder of Minor International, which runs hotels, restaurants, and retail outlets across Asia. Well, a Hong Kong court has sentenced former democracy advocate Benny Tai to 10 years in prison in the longest sentence ever imposed under a China-imposed security law. Our China correspondent Min Lo joins us now from the West Kowloon Magistrates Court. This is significant, Min.
Yes, and today, the weather was rainy, it was windy, and that didn't stop many of these supporters from coming, queuing outside the courthouse this morning, wrapping around this building in their umbrellas. And just now, it was quite an emotional moment when the sentences were handed out. We saw some of the supporters come out, shouting that this is really unfair, this is really unfair. There was another woman holding up a sign that said, the righteous will live and the evil will surely die, and she was immediately taken away by the police. And as you said earlier, Benny Tai, one of the most prominent ones here who is convicted today, he is sentenced to 10 years in prison. In some ways, this is the best case scenario under the circumstances because that is the lowest in the sentencing guideline. The maximum penalty was up to life in prison, and he was deemed as the principal organizer of this unofficial primary election that took place in 2020. It was deemed as an attempt to undermine the city government because the defendants had intended to gain a majority in the Legislative Council to be able to block the city leader's agenda and to theoretically force the step down of Carrie Lam, the chief executive at that time. Now, another key figure, Joshua Wong, is someone you might recognize. He is the face of the umbrella movement in 2014. He got 4.6 years in prison for participating in that unofficial primary election. The rest got a various length of sentences. Claudia Moore, for instance, another ex-lawmaker who was also a former AFP reporter, she got 50 years in prison, and we're still digesting the lengthy 82-page report that details the reasons for this sentencing.
And Min, wide-ranging implications on the prospect for democracy, the prospect for rule of law in Hong Kong. It is set to raise condemnation from the Western countries.
Yes, already this case is very closely scrutinized, and a number of conditions around this case has departed from common law tradition. For example, the defendants are not granted a jury trial, and instead they are being trialed by 3 judges handpicked by the chief executive. Many of the defendants had already been in jail for about 3 years or so, and because they were denied bail, and that had drawn criticism. And as you said, not only are countries criticizing or rather questioning whether the judiciary is independent, it's also the business community that are closely watching this. We know that Hong Kong has been trying to attract foreign investors. They are turning to regions like the Middle East, and Hong Kong last year lost the status of being the freest economy in the world to Singapore before regaining it again this year. And that rule of law, that openness, the independence of judiciary had for a long time been important pillars that really underpinned Hong Kong's status as this global financial hub.
Min, thank you so much for the update. Our China correspondent Min Lo at the West Kowloon Magistrates Court in Hong Kong. Now, this is putting the focus back on Hong Kong's reputation and viability as a global business hub at a time when some of the world's top banking executives are in the city. But Chinese officials are painting a rosy picture at the HKMA's Global Financial Leaders Investment Summit. The China Show co-anchor David Inglis is there to cover the event for us. And Dave, some top names have been speaking at the summit so far. What are you hearing?
Yeah, and I think, you brought it up perfectly then. I think you phrased it interestingly enough. You simply have to look at the guest list of who's come here and just to, I guess, in many ways address the initial part of your question there of the viability of Hong Kong as a financial center. I mean, effectively everyone in the banking world is here in town. From the U.S., in Europe, the U.K., in China. Of course, one of the initial discussions that took place here was effectively the who's who of the regulatory regime in China, the CSRC, the PBOC, the NFRA. And then the vice premier actually walked in and also gave a keynote speech, I guess to underscore as well. And the message was, to answer the second part of your question, that Hong Kong does and will continue to remain, of course, the gateway, the global gateway to mainland China. In fact, just to underscore some of the key messages that took place in the earlier discussions here, talk to us, engage with us. We're open to suggestions, and we will deepen some of these mutual market access programs as well, because we want to be able for foreign investors to share in enhanced returns when this economy turns, and that's, of course, that's a big if still. But yeah, let's listen into some of the highlights from this morning.
We are happy to see that Hong Kong has made new achievements in economic and social development. In the first 3 quarters of this year, Hong Kong has scored an economic growth of 2.6% year-on-year and a positive growth in a row of 7 quarters. Prices remain stable, unemployment rate is high. People of Hong Kong are happy. Society is harmonious and prosperous. Hong Kong is proceeding steadily towards stability and prosperity.
We have so many investors here, financial leaders. You're welcome to visit the mainland. Talk to us. We stand ready to provide easier access so that you can achieve great returns in the mainland.
Yeah, for more context, let's bring in someone who was part of the audience just now, and joining us here on set exclusively is the Aberdeen Chairman, Sir Douglas Flint. Good morning, it's very nice to see you. Thank you for taking the time to speak with us.
Pleasure.
You were just inside there, and I think that one of the things that stands out, at least to many people looking outside, looking in, you have financial regulators in China actively speaking and engaging with the private sector, foreign businesses right now. The fact that they're here on that stage speaking live, I think, says a lot. What did you take away so far from this morning?
I think that was very positive. I mean, they were projecting a very clear message that opening up continues, that there are challenges, but we're dealing with them, and we're seeing traction on the measures that have been taken within the mainland to stimulate consumption, to deal with some of the historic problems. I think reinforcement of Hong Kong's specific and very exciting role within China as an international financial centre, the role as an offshore RMB centre. It's been a very positive sentiment towards Hong Kong's role, and indeed growth in Hong Kong and China,
well, broader
China.
How has it been to be back here in Hong Kong? We were having this conversation during the break.
It's been fantastic. I mean, I think you need to keep coming back to Hong Kong just to see the vibrancy of the place. You know, I think sometimes in the West we see a sort of a slightly misleading story of how the world is in Hong Kong, or how Hong Kong is, and I just love coming back because the vibrancy, the can-do, the excitement about what the city can do, what Greater Bay Area can do, and the businesses within it. It's very, very positive.
I mean, Hong Kong depends on 2 major economies, mainland China and the U.S. Maybe let's start with mainland China, since we started on that too. Can we make the assumption that policymakers, this major policy adjustment that they've made, has gotten rid of the tail risk? to this economy?
There's always a tail risk. I mean, I think China continues to have a great number of levers it can pull, and I think it will continue to give stimulus. I think the challenging thing that policymakers all over the world have is you can do things fiscally, you can do things in terms of monetary policy, but what you find more difficult to do is stimulate consumer confidence, because ultimately you need the confidence for people to take money out of their pockets and start spending again. And I think that's a challenge in many countries in the world, and certainly has been a challenge in China. But we see many of the challenges that people faced or were thinking about at the beginning of 24 have taken place. All the elections that people talked about and worried about, you know, we don't know what's going to happen. Now we do know what has happened, and people are beginning to adjust to that.
Well, let's say one key election, of course, which took place 2 weeks ago now. What conversations are you guys having with your clients around what a Trump-led White House might mean for the world, in the world of investing?
Well, I think in many ways one of the very good things about that election, it was a very clear result. So, I mean, I think many people expected this to be a
drawn-out affair?
A drawn-out affair with all sorts of complicated discussions on the electoral process and so on, but it was very, very clear. I think all businesses benefit from doing scenario planning, stress planning, and nobody quite knows what's going to happen when we get the Trump administration in place, but it's exciting. Sorry, it's really, it's a good thing that people are thinking this could happen, that could happen, different things can happen. Let's plan for the opportunities that might arise. Let's plan for some of the risks that might arise. But we're an integrated world. I mean, those who say that globalization is over are just wrong. I mean, supply chains are integrated. Markets are open to all. I think it's an interesting world.
The conversations around in the last couple of years when the Chinese markets were in the doldrums, let's put it that way, and they're starting to get out of it right now, and who knows really when that next sort of leg up will lead. You know, a lot of asset managers, maybe like yourself and some of your peers, have come up with ex-China EM strategies, for example. You know, maybe remove China from the EM basket, because China in itself is a major story. Remove India from the EM conversation. Do you think asset managers looking at the EM basket need to be more nuanced, given how far these two economies have developed?
I don't think it's...
Or does EM still make sense as a basket?
No, I think it's more a question of our clients. I mean, we respond to how our clients ask us to invest. So if we're setting up strategies that are emerging markets like China, the clients are saying, we want to have a strategy that excludes China. And that has been the case for the last 2 or 3 years. There's been a risk-off more generally. There's been a risk-off emerging markets. There's been a risk-off China. But we've had the elections now. We're seeing the stimulus come through in China. We're seeing the Chinese economy beginning to respond. So I think we will begin to see flows coming back.
Do you think the world is still underweight? China, I'm cognizant, of course, of the noise still building in our background, right? Which I guess underscores the crowd here in place. But yes, on that question, do you get a sense that the world is still massively underweight China?
I mean, in terms of Chinese proportion of global GDP, it's massively underweight. And even in terms of its markets, it's underweight. Right. Because the indices are constructed on the basis of investable assets, which have criteria that kind of downplay China. I mean, global equities are, depending on the structure of the index, somewhere between 60 and 80% U.S. stocks, which shows how successful the U.S. economy has been and the dominance of the big 7 stocks in America. But yes, China's definitely underweight. Asia's underweight. Emerging markets are underweight, and actually Europe's underweight. We have a very polarized investment market at the moment towards the U.S.
Yeah, if I'm not mistaken, I just had a look at the statistics, and it could be dated a few weeks back. The market cap of the U.S. as a percentage of the global market cap is something north of 50%. North of 50%. Well, I want to get your take on that as well. Is the cleanest read still for dollar investors? The U.S. equity market, is that, I guess, risk reward still the place to put your money? Is the bar high, basically, to take your money out? That's what I'm trying to get to.
Certainly, if you've looked at the last 10, 15 years, being underweight U.S. has been a very bad place to be. Now, people have been saying the U.S. is expensive for some time now. At some point, that will be very true. But it really depends kind of on the rest of the world getting its act together and demonstrating they can show the same kind of growth, the same kind of profitability margin, and the same kind of trading opportunities that the U.S. has exhibited. So we shall see. I mean, it's really for the rest of the world to become more competitive, to challenge the US in terms of capital allocation.
What's the situation now in the UK in terms of inflation? Because in the US, the path arguably is clear of disinflation. The UK might have still some spurts of inflation here and there. Where do you think we are?
We've seen inflation come down very, very, very rapidly, actually, and now down round about at the policy level. We've had some public sector pay rises come through, which may just sort of temper the downward.
It's a good thing, though, isn't it?
A good thing that inflation has come down.
Yeah,
yes.
we have a little bit of inflation.
It's very good we have a little bit of inflation. I think we're not going back to zero interest rates.
Right.
And it's that balance between can we use the stimulus that's being offered by the current government in terms of unlocking pension schemes, in terms of relaxing the debt limits that they're subject to put money into the economy and investment. If that is successful, as they plan it to be, to stimulate growth in the economy, it can be very positive for the UK, yeah.
As a business, just to focus in on Aberdeen itself, what are the key priorities right now? And it's no secret to the market that the last couple of years have been challenging. Client withdrawals, fund outflows. Well, I think what's the diagnosis? Let's start there.
Well, part of those outflows are reflecting of what we talked about, that there's been risk off to emerging markets, and a large part of our business has been in emerging markets. We're doing well in alternatives, we're doing well in fixed income, which of course was our core strength because of our very strong position in serving insurance companies. We've got a very good platform business, and we've got an exceptionally strong retail investment business, so we're quite diversified. But to some extent, the flows are reflecting investor appetite for the strategies that we have been very strong in historically, which is emerging markets, particularly in Asia, and there's been less appetite for that. Hopefully that's coming back. But we've got three businesses with great opportunities.
What's the playbook now? Do you simply wait for that boat to come back, for EMs to come back, or are there, I guess, are there structural changes to strategy that you guys might need to look into, for example, in case the world has shifted more than a few degrees?
There's a whole bunch of things that we are doing. We are managing our cost base. We are looking for opportunities to grow out in private assets. But when you stand back, I mean, what we do in our core business of investment is we help people manage money for lifestyle events, whether it's saving for retirement or saving for education, schooling, weddings, and so on and so forth. That is still a core function of what we do, and particularly retirement. I mean, one of the things that I'm particularly passionate is about, we have got a demographic time bomb in terms of people not saving enough for retirement right the way across the world, right, exacerbated by a low birth rate. And I think one of the opportunities we've got, and indeed the Chancellor drew attention to it in her Mansion House speech last week, that we need to get retirement money more productively invested, taking more risk, investing in productive assets to build the infrastructure, to build the growth, to build the jobs that we need in the future. And our industry, and us within it, are very much part of that.
In its current form, Aberdeen, are you prepared to ride those changes, is what I'm trying to get to. And, we were having this conversation too before the break, and mentioned the word break. I mean, people have been talking about the need for a breakup, for example, that, the sum of parts are probably worth a lot more than the current sum of the parts. Like, where is your head as far as that?
We certainly think we're worth a great deal more than our current stock market capitalization, but many companies would say that. Look, we have three very good businesses. One is doing very well, one is one we are rebuilding to some extent, and one we have got actions to do to alleviate the disappointing flows in our platform business. But we have three very good businesses. So it's not a question of riding out the storm or waiting for things to change. There are actions that we can do, but it's simplistic to say build it up, break it down, build it up, break it down. We're there for the long term.
Yeah. Sell more, as they say. Sell more, cut your costs.
Every business goes through cycles, and you benefit, you get stronger by dealing with the challenges that you're faced with rather than discarding the challenges because they're difficult.
Right, and suffice to say, the board is completely confident, of course, in the new CEO, of course, who is...
We're very confident in the new CEO. We're very confident in our businesses.
Okay, let's talk macro again and take a step back. Going into next year, we have a couple of challenges. Inflation might still remain. We have a couple of hot wars around the world. We have a Chinese economy that might take more time to turn around. What are some of the key risks that you are keen on watching going into? What do you think bleeds into next year that you think we should be worried about?
I think
what worries you?
I think one of the key risks is protectionism. You know, I think that if we enter a world where people set up barriers to trade, that is costly, that is inflationary, and inflation is nobody's friend. So that is one of the risks. The other big risk that I think everybody is worried about is just technology has huge opportunities and huge threats. I mean, the growth of AI in the hands of bad actors is horrendous. Cyber risk is a meaningful risk that everybody has to deal with. But you know, I think there are as many opportunities. I think we're coming off a period post-pandemic where economies are rebuilding, economies are looking to deal with the aftermath of all the electoral changes we've had in the last year to sort of say, how do we build the economies after the pandemic and get the growth going again, get more productive assets into the system that will support the ambitions we have for the people in each country.
Do we need to get used to inflation being back?
Yes.
Interest rates?
Modest inflation is good.
Okay. Do you think interest rates will not return to pre-pandemic levels? I think it's the other part of the question right now.
No, they're not going to return to pre-pandemic level.
Is the sense that central banks might not be able to take rates all the way, not all the way back down, but certainly the easing cycle might be shorter than what we currently think? You know, how are we planning our businesses right now?
I think market consensus is that there will be fewer interest rate cuts than people were projecting 3 or 4 months ago.
Yeah.
I think it's difficult to say where that will end now, because I think we do need to see what the policy of the new administration in the US is going to be, and we need to see, we've got some very important elections in Europe coming up over the next couple of years. And, you know, we've got a government bedding down in the UK. So there's a lot of moving parts.
Yeah. Final question for you. You mentioned alternatives. That's a big part of the conversation here as well. Is that a structural shift now from asset allocators into alternative assets, private markets, and the like?
One of the consequences of the financial crisis, which is now, 16 years ago, was a desire to rebalance the financial system, to take some of the asset concentration out of the banking system and move it into the asset management system. So the distinction between private and public markets in terms of assets is becoming less marked than it was in the past. So yes, I think we're going to see a more balance between public and private markets than we saw before, and I think that's good for risk management, and it's good for regulations.
Sir Douglas Flint, thank you so much for your time and the patience, and of course riding through all this noise. Sir Douglas Flint, their chairman at Aberdeen. Hats back to you.
Interesting, Dave. The increasing convergence of public and private markets. We keep hearing that over and over again. Thank you so much for that conversation. Now, still ahead this hour, DGA-Albright Stonebridge Group joins us to discuss the future of U.S. and China trade ties under a second Trump presidency. Plus, we'll get insights on the global hospitality sector with minor International Chairman Bill Heinecke. That's coming up. Keep it here with us. This is Bloomberg. Let's take a look at U.S. futures after that run-up overnight. Of course, we have the S&P futures currently building on that rally, up about 1/10 of 1%. We have Goldman also weighing in optimistic about a continued rally. It says it sees a 10% upside from here till the end of 2025. Of course, that's on the back of that Treasuries halting the decline, yields trending a tad lower to 4.4% from 4.5%. Now, still to come, the future of U.S. and China's trade ties are in focus as Donald Trump prepares to return to the White House. DGA-Albright Stonebridge Group shares their insights next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. A Hong Kong court has sentenced former democracy advocate Benny Tai to 10 years in prison in the longest sentence ever meted out using a China-imposed security law. Tai was among 45 defendants sentenced on Tuesday, nearly 4 years after they were arrested in a sweeping police campaign. The punishment is expected to further deter dissent in Hong Kong and attract condemnation from Western governments, which have called the case politically motivated. Now, the case involving Hong Kong activists was a point of tension at the G20 summit in Brazil as the Chinese president met with the UK Prime Minister. Bloomberg's Avril Hong is following developments. Avril.
Yeah, Has. I mean, this meeting was supposed to be an opportunity to sort of facilitate the warming of ties between the UK and China, the first meeting between their leaders in 6 years. And we've heard how Keir Starmer has been kind of advocating this pragmatism in dealings with China. And it was around the time when he was listing out the points of tension. You think about Taiwan, human rights, Hong Kong, rights activist Jimmy Lai, when things took a really awkward turn. Have a listen.
I'm very pleased that my Foreign Secretary and Foreign Minister Wong met recently and discussed respective concerns, including human rights and parliamentary sanctions, Taiwan, South China Sea, and our shared interest in Hong Kong. We are concerned by reports of Jimmy Lai's deterioration health in prison.
Now, it was around this time when the British journalists that were in the room were ushered out by the Chinese side. The entourage of Keir Starmer tried to intervene, say, hey, let the reporters stay. But ultimately, those British journalists were physically removed from the room. And this, I think, just highlights the sensitivities in mentions of Hong Kong and Jimmy Lai by the UK in particular, given its role in the territory as a former colonial power. And it also speaks to the challenges that are facing Keir Starmer as he seeks potentially these deeper economic ties with China at a time when growth in the UK is not so hot. China is still a really important trading partner for the UK. Now, it's also coming weeks ahead of Trump's return to the White House, and we've seen how in his first administration, they really targeted these Chinese officials with sanctions, and this was over their really assertive stance over Hong Kong. And so far, they've kind of stocked the cabinet with those that can hit the ground running when it comes to, America First policies, including those two men we know of that have really strong anti-China views, Marco Rubio and Mike Waltz.
That's right, China hawks. Avril Hong, thank you so much for that. While China has emphasized its desire for healthy and sustainable relations with the U.S., it's also bracing for a new trade war under Trump. Let's discuss this and more with Amy Celico, partner at DGA-Albright Stonebridge, which provides global strategic advisory and commercial diplomacy services. She co-leads the firm's China practice and was senior director for China affairs at the Office of the U.S. Trade Representative. Amy's also been a diplomat for the U.S. Department of State, Defense and Commerce. Amy, good to have you with us. From what we heard from Avril, you can only imagine that tensions will remain, and already today, I can only imagine the U.S. will respond to the sentencing of those pro-democracy activists.
Yes, we certainly anticipate that. I mean, the U.S. Department of State has been consistent in calling out these charges as politically motivated, as you just said. And so we're going to have to balance for the last 2 months of the Biden administration, trying to remain consistent and tough on China on those issues as they're handing over power to the Trump administration starting January 20th, wanting to have that consistency while also not seeing a crisis during this interim period between the Biden administration and the incoming Trump administration is important for the U.S. government. And so that consistency will certainly be picked up by the new Trump administration. You just pointed out out Senator Rubio, Congressman Walz, two of Congress's toughest critics on China, including Hong Kong. That means this is going to be an issue from day one for the new administration as well.
Not a great start to Trump's administration when it comes to relations with China. The thing is, in Peru, Xi Jinping had a pretty constructive tone to how he wants to work with Trump. Is that even possible? Can they build on that 1.0 relation, Trump 1.0 relations?
I think they can. Absolutely. President-elect Trump has made no secret of putting in his cabinet-to-be, if confirmed, some pretty staunch China critics. And at the same time, President Trump talks about his own relationship with President Xi Jinping and wanting to have a tough but firm set of America First policies. That means that competition is going to continue. Inevitably, it's going to lead to an increase in tensions between the U.S. and China. But of course, the first and second largest economies in the world are going to have a relationship. A tough one, with a lot of ups and downs over the next 4 years.
In the end, though, it is about tech supremacy. Both sides want to be the leader in high technology. It is about chips. When we take a look at those tariffs that Trump implemented under Trump 1.0, they didn't really work. Because in the end, China managed to get a bigger share of the global trade out there. So I'm just wondering how successful Trump might be in imposing those 60% tariffs and, I guess, causing pain to China.
Well, I think the rationale for the tariffs has shifted somewhat. In Trump 1.0, I think the rationale for the tariffs really was to rebalance U.S.-China trade. But to your point, in Trump 2.0, it's about national security, it's about tech competition, it's about in President-elect Trump's views, not just managing a competition with China, but winning it. And so, indeed, we are going to see the Trump administration think about tariffs in terms of disenabling China from benefiting from a strong relationship, economic relationship with the United States, reducing U.S. vulnerabilities to reliance on the China market. On technology, both countries are going to continue to double down on increased export controls, increased investment restrictions, and continue to have a highly contentious relationship when it comes to high tech, because that competition is so central to U.S.-China overall competition.
The thing is, some surveys are already suggesting that China leads in about 5 out of 13 key technologies. And when it comes to chip self-sufficiency, China will reach, I think this is according to Goldman, that it will reach 40% by 2030. And that is something I can only imagine the U.S. does not want to see. How does the U.S., what step can the U.S. take to impede, I guess, that journey for China?
Well, for the Biden administration, of course, they have focused very much on investing in the United States and enhancing relationships with key technology partners like South Korea, Japan, Taiwan, of course, on semiconductors, to both rely more on U.S.-driven innovation to continue to stay ahead of that competition, but yes, indeed, also preventing China from being able to continue to innovate in the highest portions of that tech competition where quantum computing, AI are at stake here. And so, of course, Xi Jinping is focused on domestic development, indigenous innovation, but he too relies on global innovation ecosystem. And so we're going to see this intense competition continue on technology issues.
Interesting you talked about ecosystem, because the U.S. manufacturers actually rely on cheap Chinese products for their own manufacturing, including in the area of defense. How might that play out?
Well, we're already seeing it play out, in fact, with China enhancing its export control restrictions on the ability of products going from China to the United States. It is going to impede some elements of our defense capabilities. But that is precisely why so many officials in the Trump administration, the incoming administration, are saying we have to stop those dependencies now. And so we do have to look at global supply chains and shifting production of components sense that, to the present, we've relied upon China, not having that reliance because that reliance is seen as a vulnerability. In the short term, certainly there are going to be challenges for China, for the United States, overcoming those dependencies. But that is the goal, to reduce those dependencies.
So in the end, do we see complete decoupling?
I think between the two largest economies in the world, neither is that desirable nor realistic. But in some areas of very intense competition, we are going to see this bifurcation until the two countries can see that they can manage competition in a more constructive way. I don't think that's a goal of the incoming Trump administration, and frankly, I don't think it's a goal of President Xi's either. Listening again to what he's been saying, both in Peru and in Brazil, is trying to shape the world perspective of China as an alternative to the United States. President Xi doesn't talk about the United States explicitly, but implicitly he's saying that China has a different model of a more multipolar world, and one that will be more filled with peace and prosperity for more parts of the world. Is that a compelling argument? I haven't seen that yet, but that's certainly what President Xi is trying to promote.
So, Amy, what does it mean for the rest of the world? I mean, it's going to be a pretty divided world. I mean, you talk about decoupling, not completely, but in the end, countries will be taking sides on who they want to do more business with.
Well, countries don't want to take sides, and they're certainly telling that to the United States and to China. But you're right.
We have heard you say you're either with us or against us.
Yes, it is easy to say, but where are the carrots and sticks in that policy, even with our closest allies? I think around the world, partners are waiting to really see not what President-elect Trump says, but what he does after January 20th. Is he going to put across-the-board tariffs on products coming in from around the world, not just at countries where there are real competition like China? And so President Trump is going to be tested by this America First set of policies that many of those that he's choosing in his cabinet are promoting. But they're also going to have to think about what will this mean for countries turning away from the United States and towards China. That is not what he wants to see. And so we'll see some mediation there as the Trump team thinks about its top priority, and that is winning a competition with China, but maybe not being able to go it alone in pursuit of that objective.
Amy, great insights. Thank you for joining us today.
Thank you.
Amy Celico, partner at DGA-Albright, Stonebridge. Well, still to come, minor International Chairman Bill Heinecke will be joining us exclusively. Hear why he thinks the travel industry's robust recovery is not slowing down anytime soon. Keep it here with us. This is Bloomberg. Welcome back. Hedge fund titan Ken Griffin is raising concerns about tariffs, a key part of President-elect Donald Trump's economic agenda. The Citadel CEO says he is very anxious about the strategy and says it's a long, slippery slope that may be profitable in a short run but could harm competitiveness longer term. And it's not just investors coming to grips with the prospects for higher tariffs, as its impact in the form of higher inflation could hit many industries, including retail and hospitality. Now, speaking of hospitality, our next guest has become synonymous with hospitality leadership in Asia. He runs one of the largest such businesses in the Asia-Pac. Minor International is a hotel owner, operator, and investor with a portfolio of over 560 hotels in 57 countries. It's also one of Asia's largest restaurant companies with over 2,600 outlets in 24 countries. Joining us exclusively now is company founder and chairman Bill Heinecke. Bill, good to have you with us. I mean, how are you reading the macro background in the world today?
Very positively from a tourism standpoint. You know, we're seeing increasing numbers. We just announced our third quarter. We had a 9% top line growth. Overall, we had 11% EBITDA growth, and we had 19% net core profit growth. So, you know, these are strong numbers, and this is before we get into the peak season for us, which is the fourth quarter.
But you have to acknowledge there are challenges ahead. I mean, China's nascent recovery may be hurt by the tariffs that perhaps Trump would impose. We have the IMF saying that global growth is slowing down on the back of that as well. I mean, surely there are risks out there, and that could be, hurting your growth prospects.
We certainly see risks. The weakest one in the chain right now is China. China has been very slow recovering all the way from COVID, and that affects absolutely the outbound traffic from China. But, what we've seen is a strong recovery from Europe and the U.S., and I think in spite of any tariffs or trade wars that may be coming up, we don't see much slowdown on the tourism sector, even with China not fully participating.
Talk to us about what's happening in China. Outbound travel, not quite to pre-pandemic levels. Talk to us about the numbers you're seeing and what kind of recovery are you anticipating?
We're anticipating a recovery in 2025 we're very strong in China in the domestic food business, but that has been a very slow recovery. We've just launched another brand in China with Thai street food, and we expect that to be quite strong. Domestic tourism is still holding up, but really the outbound traffic isn't there. And the flight capacity, even into China and out of China, is still well below the COVID period, pre-COVID.
How encouraged are you by the stimulus you've seen so far? And do you see that trickling down to consumption eventually?
We do. We see it happening really in 2025. I think the government is well aware of the weak economy, and they're really trying to address it strongly now. So that only poses more upside for us in the tourism industry and in the consumer sector. So we're pretty optimistic for 2025. We can already see our first quarter numbers, and they're extremely strong. Fourth quarter is extremely strong. There's been a bit of volatility with the Thai baht, which affected our reported earnings, but our core profits have never been higher.
You talked about how you've been encouraged by some other markets which can counter the slowdown in China. Which markets in particular? People talk about how, they're optimistic about the markets in the Middle East, for instance. 40% growth is a number people are throwing out there. What are you seeing?
We're seeing, very strong growth coming out of the Middle East. The Middle East remains one of the central hubs for travel to Asia, and also travel from Asia into Europe. Our numbers for Europe are still strong. Our numbers for the Middle East are strong. Our numbers for Africa are strong. It's hard to find any weakness with the exception of China. We're pretty optimistic. We're well diversified. We're operating in 67 countries total. So we feel the strength of the rest of the world, and we don't anticipate much of a hiccup over the next 6 months.
Are you not being hindered by the lack of capacity for airlines? We've had the representative from the airline industry saying that, airlines are up in arms because of supply chain issues and they're unable to meet demand. Capacity is being impeded. I mean, how is that impacting your business?
Well, I think we're certainly missing the strength of Thai International, which, as you know, is just coming out of bankruptcy, and that affects Thailand, certainly the weakness of Thai International, which we've had previously. But generally speaking, I've seen AirAsia's capacity back up to its pre-COVID levels now, and their numbers are very strong. So we're seeing the whole travel and tourism industry recovering quite quickly. Rates are much higher for both, whether it's airline fares or it's hotel room rates. And we're seeing occupancy slightly higher too. So we're coping pretty well, considering that we're not yet back to full capacity. But I'm pretty optimistic that by the first quarter of next year, you'll see a lot of that recovery.
You talked about how rates are higher in terms of RevPAR. What are you looking at? And for 2025, how does it look?
2025, again, as I mentioned, looks very strong. We're really seeing very few hiccups. We're looking at a very strong European summer again coming up in 2025. The first quarter is very strong.
Put a number to it, Bill. Can you quantify strong? Put a number to it.
Put a number to it. I think we would expect to see double-digit profit growth this coming year. We also have been reducing our leverage. We expect to also float a very strong REIT in 2025, which will further reduce our leverage. We were definitely affected by the high interest rates that we saw, but interest rates have been coming down, and that's been giving us a boost to our profits globally.
Any reason to think you'd be interested in acquisitions? When you take a look at the hotel space, for instance, Japan has seen a lot of M&A activities. That's driven pretty much by the weak yen. Are you looking at Japan or some other markets in terms of M&As or assets you may want to acquire?
Absolutely. We're still very, very weak in North America. We're not in Japan. We hope to announce something in Japan in early 2025. We've got a hotel finally coming up in Singapore, which will open in 2026, that we will own ourselves. So we're really remaining optimistic that we can plug and play in a lot of the markets where we're not. We just opened 2 NH hotels in Sri Lanka. We opened an NH hotel in South Africa, in Johannesburg. So we're also seeing our opportunity for NH to go eastward and open more hotels. And that's really helping us a great deal. Even in spite of the economy, if it should weaken a little bit, we've got so much blue space left to grow and plug in new brands.
Bill, you talked about your liabilities earlier. I think that amounts to about $7.3 billion. I mean, what's the ideal amount of debt for you as you talk about bringing it down?
I think we'd be very comfortable at probably cutting that in half, and that's one of the targets that we've set for 2025. So we anticipate really being able to do that through a REIT. We own a great number of hotels that are on our balance sheet. So if we're able to redeploy them, we did sell a few in 2024 and 2023, but we'd rather stick them into a REIT. So I think that will have a very major impact on us, and that's one of the things we're looking forward to in 2025.
White Lotus Season 3, Bill. I mean, your hotel in Koh Samui was featured in White Lotus Season 3. Do you think that would have any ripple effects for you, for the Thai hospitality industry?
Absolutely. I think the White Lotus effect, we've already seen it. It's having a huge impact on Thailand. As you probably know, they filmed in 5 of our hotels that we own, 4 in Samui and 1 in Phuket. And so we're expecting a huge impact on that when that airs in January. It's had the same impact in Hawaii and Sicily after it aired. So this promises to be a barn burner and probably one of the brightest spots on the Thai tourism market. Because Thailand's shooting for 45 million tourists, we hope, in next year. The government has put it at 40 million plus. We're looking at closer to 45 million. We think the numbers are going to be very strong for Thailand.
And linked to that, Bill, social media, it's changing the face of travel. I mean, how are you coping with that? How are you capitalizing on it?
Well, one of our big moves has been into wellness. We've just opened a new clinic in Phuket for longevity, and we're seeing tremendous interest, post-COVID, of people wanting to travel and yet pay attention to their health or anti-aging and what have you. So we're trying to capitalize on that, along with the other things that people want now is great experiences besides wellness. So we have trains, planes, and boats that we have featured in our portfolio this year. We're just launching a new boat in Laos with 14 cabins that will cruise the Mekong River.
Bill, thank you so much for joining us. Bill Heinecke, founder and chairman of Minor International. Before we go, let's take a look at how oil has been trading. Of course, we saw that biggest jump in about 5 weeks. Let's take a look at where oil is trading right now. Brent crude at $73.49, New York crude at $69 a barrel. Of course, bear in mind, there's a glut happening when it comes to the oil space there. Now, before we go, here's a look at our guests for tomorrow. We'll discuss investment strategies with Oaktree Capital Management's Howard Marks, the CEO of Indonesian telco ASEAN Ahead. Also will be joining us, and we speak exclusively with the Morningstar CEO about the future of AI in finance. That is it for Insight, and this is Bloomberg.